With yields upwards of 10 or 20%, are covered call or buy write ETFs a smart choice? Or is there a catch that you should be aware of? That's what someone in my Discord asked me recently, so I'll be answering it here in this video. There's the old saying, when something seems too good to be true, it probably is, right? I think that's the case here. So what exactly are covered call or buy write ETFs, and why are their yields so high? Well, essentially, they're ETFs that buy stocks and write, aka sell, call options on them. I'll explain call options in a second, but together, when you own a stock and sell a call option on it, that's known as a covered call. So these ETFs are sometimes called buy write or sometimes called covered call, but they're the same thing. These took in more than $25 billion in inflows in 2023 since they offer a high yield and were seen as an alternative to bonds as interest rates were rising. I think these are a terrible alternative to bonds, and you'll see why by the end of this video. Let's start with the basics. A call option is the right to buy a stock at a specific price in the future, called the strike price. If you have the option to buy it, that means you get to wait and see if it goes up and then decide if you want to buy it at the lower price. Pretty cool, right? So if the stock price goes above the strike price, you get to buy it for cheaper and make an instant profit. If the stock price goes down, you don't really care because you don't own it. So when you buy a call option, you get all the upside if the stock goes up a lot, but no downside if it goes down, other than what you paid for the option. Covered call ETFs are on the other side of that. They are selling, aka writing, call options. Since they're covered, that means they also own the stock. So covered call ETFs buy stocks and then sell call options on them. These options cost money, which is where the income comes from. They're selling away their potential gains on the stocks they own. The more volatile the stocks and the more upside potential they have, the more expensive the options will be, and the more income the ETF will generate. However, that also means more downside risk. So there are two key takeaways here. First, covered call ETFs look great because of the high yield, but when you buy them, you're taking on all the risk if the stocks go down, and you get none of the upside potential if they go up because you sold it away to the person who bought the call option from you. So essentially, you're taking stock-like risk for bond-like returns. That's why I think they're a terrible alternative to bonds and generally not something I would recommend people buy. You're basically betting on the market to be flat. If it's flat, you get to collect your premiums for selling the call options, you don't miss out on any big gains, and you don't experience any big losses. But how often is the stock market flat? These are the historical S&P 500 returns each year going back to 1928. The stock market averages around 8 to 12% returns per year, but it almost never earns that in a specific year. It's big up years and big down years. The big up years are needed to make up for the losses in the bad years. And with covered call ETFs, you take away your ability to participate in those over time. Let's take a look at a real life example of QYLD, the Global X NASDAQ 100 covered call ETF. You can see over 10 years, it's earned a return of almost 100%. Not bad, right? Sure, except that if you'd actually just invested in the regular NASDAQ 100 ETF with no covered calls, you would have made over 400%. And yet, you still got crushed in 2022, just slightly less than the regular stock ETF. The second takeaway is that options on stocks with more volatility are more expensive. That means that the bigger the income on the ETF, the more volatile, aka risky, the underlying holdings are. In general, the higher the yield on a covered call ETF, the more likely it is that you'll have a massive loss that will be very difficult to come back from. So while covered call ETFs can work at certain times when the market is mostly flat, it's very difficult to predict when that will be, and you're almost certain to be worse off in the long run than just buying stocks because you get pretty much all of the downside risk with almost none of the upside potential. Not a good deal, if you ask me. And if you want more investment insight from me, check out the link below to my free Discord, and I'll see you in the next video.